Jenna, I think revenue recognition gets a reputation for being complicated because people jump straight into memorizing 5 steps. But I don't think that's the real challenge.
I agree. The 5 steps are actually pretty logical. The hard part is knowing why they exist. Revenue isn't just recorded when cash comes in. Revenue is recorded when the company earns it by transferring goods or services to a customer. That's the entire purpose of this standard.
So if someone listening remembers only one thing before we dive into the details, it's this. Revenue follows performance, not cash.
Exactly. Cash and revenue often happen at different times. Sometimes the customer pays first, sometimes the company performs first. The accounting simply keeps track of who still owes what.
I like thinking about it like ordering custom furniture. You might pay today, but that doesn't mean the company earned the money today. They still have work to do.
That's a great analogy, Russell. The only place it starts to break down is that sometimes companies earn revenue gradually while they're building something, instead of only when they finish. That's one of the biggest ideas we'll get to later.
So today's episode is really about learning the map before worrying about every street.
Exactly. The textbook starts by explaining that revenue recognition applies to transferring promised goods or services to customers. The amount recognized should reflect the consideration the entity expects to receive. Everything else supports that goal.
Now, let's build the map.
The entire model revolves around 5 steps. Step 1. Identify the contract. Step 2. Identify the performance obligations. Step 3. Determine the transaction price. Step 4. Allocate that transaction price. Step 5. Recognize revenue when or as the performance obligations are satisfied.
5 steps sounds easy enough. But I know FAR likes testing where students mix up one step with another.
Very often. A question may sound like it's asking about revenue timing, but really it's testing whether you identified the correct performance obligations. Or it might seem like a pricing question, when it's actually about whether a contract even exists.
So, let's start with step 1. What's actually considered a contract?
The textbook says a contract creates enforceable rights and obligations. It has to be approved by both parties. The goods or services have to be identifiable. Payment terms have to be identifiable. The contract must have commercial substance. Finally, it has to be probable the entity will collect substantially all of the consideration.
That last one seems important.
Very important. If collection isn't probable, revenue recognition doesn't simply begin because somebody signed paper.
So the company needs a real contract, not just a hopeful handshake.
Exactly.
The textbook also mentions contracts being combined. That sounds like one of those little exceptions exam writers love.
Absolutely. Sometimes 2 separate contracts are really one commercial arrangement. If they're negotiated together as a package or one contract's pricing depends on another, they may be accounted for as a single contract.
So don't automatically assume one piece of paper equals one accounting contract.
Exactly.
Then we get contract modifications. Those always make students nervous.
Mostly because they sound more complicated than they are. If the scope or price changes, you first decide whether the modification creates a completely new contract or whether it's really just changing the existing one.
Again, we're still asking one question. What exactly has the company promised the customer?
That's the perfect way to think about it.
All right. Step 2. Performance obligations. I've heard people say this is one of the most tested areas.
And for good reason. A performance obligation is simply a promise to transfer a good or service. But here's where students get tripped up. Not every promised item becomes its own separate performance obligation.
Here's my analogy. Imagine buying a hamburger meal. You get the burger, fries, and drink. 3 things. 3 obligations. Simple?
Sometimes. Now imagine hiring a contractor to build your dream house. Sure, they're providing lumber, plumbing, electrical work, roofing, drywall, and dozens of other pieces. But are you really buying 50 separate products? No. You're buying one finished house. That's exactly why the textbook's construction example becomes one performance obligation.
I like that. The customer isn't shopping for individual nails. They're buying a completed home.
Exactly. The textbook says 2 conditions have to be satisfied. First, the customer can benefit from the item either by itself or with other readily available resources. Second, the promise must be separately identifiable from the other promises. Both conditions matter.
And this is where the software example helps.
Right. The textbook gives software, installation, updates, and technical support. Because those promises are separately identifiable, they become 4 separate performance obligations.
So construction becomes one. Software package becomes several.
Exactly. Always ask yourself whether the customer is really receiving separate promises or one combined promise.
That's a much better mental shortcut than memorizing random examples.
Exactly.
Step 3. Money. Finally, something accountants enjoy.
Not just money. Expected consideration. The transaction price is what the company expects to receive in exchange for transferring the promised goods or services.
Seems straightforward.
Until it isn't, because now we introduce variable consideration.
Discounts, bonuses, refunds, performance incentives, things that change the amount.
Exactly. The company estimates the amount it expects to receive.
The textbook also brings up time value of money. That always catches people.
Yes. If payment occurs significantly before or after performance, financing may exist. That means part of what looks like sales revenue is really interest. The textbook's furniture example demonstrates exactly that.
So, if someone waits years before paying, we're not pretending every dollar represents revenue. Some of it compensates for the time value of money.
Exactly. The standard wants revenue to reflect the value of what was sold, not financing income.
Then there are non-cash payments.
Measured at fair value. And don't forget consideration payable back to the customer. Sometimes rebates, credits, or vouchers reduce revenue instead of becoming expenses.
Lots of little adjustments. But they're all trying to answer the same question. What's the real economic price of this deal?
Exactly.
Step 4. Splitting up the pie.
That's actually a great analogy. Suppose one customer pays one total price but bought several separate performance obligations. Now you have to divide the transaction price among them.
Not equally.
Correct, according to standalone selling prices.
So if one item normally sells for much more than another, it receives a larger portion of the revenue.
Exactly. The textbook's software example illustrates this perfectly. Revenue gets allocated among the license, installation, and technical support based on their standalone selling prices.
Here's what I notice. Nothing magical happened. We didn't create more revenue. We just divided existing revenue fairly.
Exactly. That's an important distinction. Allocation changes where revenue goes. It doesn't change how much total revenue exists.
Then we finally reach step 5. The step everybody thinks about first.
Exactly. Revenue is recognized when or as the performance obligation is satisfied. Notice those words. When or as. Sometimes it's one moment. Sometimes it's gradual.
This feels like the biggest decision in the whole chapter.
It probably is. The textbook explains that performance obligations may be satisfied over time or at a point in time.
Let's start with overtime.
Revenue is recognized over time if one of the qualifying criteria is met. For example, the customer receives benefits as the company performs, or the work creates or enhances an asset the customer controls, or the company has no alternative use for the asset and has an enforceable right to payment for performance completed to date.
That last one sounds intimidating.
Until you think about custom construction. You're building something specifically for one customer. You can't easily sell it to someone else. And if the customer walks away, you're entitled to payment for the work already completed. That's exactly why many construction contracts qualify for recognition over time.
So, instead of waiting until the entire building finishes, revenue gradually follows the progress.
Exactly.
How do companies measure that progress?
The textbook discusses output methods and input methods. Output methods measure what has actually been delivered or completed. Input methods focus on resources consumed, such as costs incurred. The method should reasonably measure progress.
Then there's the opposite. Point in time.
Right. If the overtime criteria aren't met, Revenue is recognized when control transfers. The textbook lists several indicators. The customer has legal title. The customer has physical possession. The customer has accepted the asset. The customer has significant risks and rewards of ownership. And the company has the right to payment.
So instead of asking, did work happen? We're asking, has control actually changed hands?
Exactly. Control is the central idea.
The textbook spends time on contract assets and contract liabilities too. Those names sound confusing.
They're actually very logical. A contract asset exists when the company has performed, but doesn't yet have an unconditional right to payment. A receivable requires an unconditional right to consideration.
So every receivable starts with stronger rights than a contract asset.
Exactly. Meanwhile, a contract liability means the customer paid before the company performed. The company still owes goods or services.
So here's my shortcut. Contract asset. Company is waiting to earn unconditional payment. Contract liability. Customer is waiting for promised performance.
That's an excellent summary.
Now, construction contracts. This feels like an entire exam topic by itself.
It definitely deserves attention. The textbook separates contracts recognized over time from those recognized at a point in time. If the over time criteria are satisfied, revenue is recognized throughout construction using progress toward completion. If they aren't satisfied, revenue waits until completion.
There's also that pass key.
Yes, definitely remember it. Students frequently confuse estimated costs incurred to date with estimated costs to complete. The textbook specifically warns about this because they're used differently when computing completion percentages and estimated total costs.
That sounds exactly like the kind of wording FAR likes using to trap people.
Absolutely. Pay close attention to the terminology before touching the calculation.
One thing I appreciate about this chapter is that almost every complicated rule is really answering one basic question. What exactly has the company earned?
That's the mental model I'd carry into the exam. First, identify the promises. Then determine what the customer is paying. Then match revenue to the promises as they're actually fulfilled. Everything else is detail.
So, before we wrap up, let's run through the map one more time. Real contract. Identify the promises. Determine the real transaction price. Allocate that price. Recognize revenue when control transfers or as performance occurs over time.
And don't forget the high-value distinctions, distinct versus non-distinct performance obligations, over time versus point in time, contract asset versus receivable, contract liability versus earned revenue, construction contracts that qualify for overtime recognition versus those that don't. Those comparisons are where your understanding really gets tested.
I think that's what makes this topic manageable. Instead of memorizing dozens of isolated rules, you're really learning one decision process.
Exactly. If you understand the logic behind the 5-step model, the examples become much easier to reason through because every question is asking where you are in that framework.
And that's a much better place to be than trying to memorize every journal entry you've ever seen.
Couldn't agree more. On the FAR exam, understanding the framework is what lets you work through unfamiliar scenarios with confidence.